Mortgages Demystified, Listeners Q&A and Real-Life Scenarios. Welcome to what might be the most practical episode we've ever done. Over the past few months, you've been sending in questions about Israeli mortgages. Lots of questions. And I get it. Israeli mortgages are complicated. They work differently than mortgages in other countries. And getting this decision right matters enormously because we're talking about what's probably the largest financial commitment of your life. So today, we're doing something different. Instead of a traditional article, I'm going to answer the real questions that real people have asked us. These are your questions, from listeners, readers, and clients. And I'm going to answer them honestly, practically, and with real-life scenarios that show you exactly how this all works in practice. Question 1. I'm new to Israel. Can I even get a mortgage? This is probably the most common question we get from new immigrants, and the answer is yes, but with some conditions. Israeli banks will lend to new immigrants, but you need to meet certain criteria. First, you need to have been in Israel for at least 6 months, sometimes a year, depending on the bank. Second, you need documented income from an Israeli source. This is the big one. If you're working for an Israeli company or are self-employed in Israel with Israeli income, you're in good shape. Third, you need that down payment, typically 30% of the purchase price. Let me give you a real scenario. Sarah made Aliyah from New York 18 months ago. She's a software engineer working for an Israeli tech company, earning 25,000 shekels per month. She's found an apartment she wants to buy for 2 million shekels. She has savings of 700,000 shekels. Her monthly income is stable and well documented. For Sarah, getting a mortgage is very achievable. Banks will compete for her business because she's a low-risk borrower, stable income, substantial down payment, working in a growth sector. Now, contrast that with David. David made Aliyah 6 months ago. He works remotely for an American company, earning $8,000 per month. He wants to buy an apartment for 1.8 million shekels and has 540,000 shekels saved. David's situation is trickier. Some banks won't lend to him at all because his income is from abroad. Others might, but they'll want more documentation and possibly a higher down payment or interest rate. The key takeaway: if you're a new immigrant, establish yourself financially in Israel first. Get an Israeli job if possible, build a payment history, live here for at least a year, before attempting to buy property. Question 2. What's this mixed interest rate thing? It sounds complicated. You're right, it is complicated, and it's also one of the most distinctive features of Israeli mortgages. In many countries, you choose between a fixed rate or a variable rate for your entire mortgage. In Israel, you typically split your mortgage into multiple tracks, each with different interest rate structures. Here are the common tracks. Fixed rate, where the interest rate is locked in for a set period, usually 5, 10, or 15 years. Prime-based, where the rate is tied to the Bank of Israel's prime rate. Index-linked, where your loan principal is linked to the Consumer Price Index. And fixed and shekels non-linked, which is increasingly popular. Let me show you how this works. Rachel and Michael are buying an apartment for 2.5 million shekels. They have a down payment of 750,000 shekels, so they need a mortgage of 1.75 million shekels. The bank offers them this mix: 600,000 shekels at fixed rate of 4.5% for 10 years, 500,000 shekels at prime minus 1%, and 650,000 shekels at index linked with 2% interest. Why this mix? The fixed rate gives them stability. The prime-based track gives them exposure to lower rates if the Bank of Israel lowers interest rates. The index-linked track provides protection against inflation and typically has the lowest real interest rate. This diversification is actually designed to protect borrowers. Instead of betting everything on one rate structure, you're spreading risk. The downside? Complexity. Your monthly payment can change, which makes budgeting harder. Question 3. How much can I actually borrow? What will my payments be? Banks use a formula to determine how much they'll lend you, and it's based primarily on your income and existing debt. The general rule is that your total monthly debt payments shouldn't exceed 40% of your gross monthly income. Let's work through a real scenario. Yoni and Tamar are a young couple. Yoni earns 18,000 shekels per month as a teacher. Tamar earns 22,000 shekels per month as a nurse. Their combined gross monthly income is 40,000 shekels. 40% of 40,000 is 16,000 shekels. So the bank will approve a mortgage where the monthly payment doesn't exceed 16,000 shekels. But here's the catch. They have a car loan with monthly payments of 2,000 shekels. Now their available monthly payment for a mortgage is 14,000 shekels, which reduces the loan amount they qualify for to about 2.6 million shekels. The lesson here? Just because a bank will lend you a certain amount doesn't mean you should borrow it. Leave yourself breathing room. Question 4. I'm self-employed. Can I get a mortgage? Yes, absolutely, but be prepared for more documentation and scrutiny. When you're an employee, proving your income is straightforward. When you're self-employed, the bank needs to see that your income is real, stable, and sufficient. Banks typically require tax returns for the past 2 to 3 years, financial statements prepared by an accountant, bank statements showing income deposits, and evidence of ongoing business. Let me give you a real scenario. Dina is a freelance graphic designer. Her income over the past 3 years averaged about 223,000 shekels annually, or 18,600 shekels per month. However, because she's self-employed, some banks will apply a haircut. They might only count 80 to 85% of this income due to perceived volatility. This is where shopping around matters. Different banks assess self-employed borrowers differently, and the terms can vary significantly. Work with an accountant to present your financials in the most favorable but honest light. Question 5. Should I go through a mortgage advisor or directly to the bank? This is a great question, and the answer is, it depends, but often using a mortgage advisor is worth it. A mortgage advisor works with multiple banks so they can shop your application around and compare offers. They understand the nuances of different banks' policies. They handle the paperwork and negotiations. They can often get better terms than you'd get going directly to a bank. The cost is typically 0.5% to 1% of the loan amount. On a 2 million shekel mortgage, that might be 10,000 to 20,000 shekels. Let's look at a scenario. Amir and Sigal need a 2.5 million shekel mortgage. Going directly to their bank, they get offered a package with a blended rate of 4.7%. They hire a mortgage advisor for 15,000 shekels. The advisor gets them a package with a blended rate of 4.3%. The difference of 0.4% on a 2.5 million shekel mortgage over 25 years is about 150,000 shekels in total interest paid. Even after paying the advisor 15,000 shekels, they save 135,000 shekels. The sweet spot for using an advisor is when you're not fluent in Hebrew, unfamiliar with Israeli mortgages, your financial situation is complex, or you don't have time to shop around yourself. Question 6. I have money abroad. Can I use it for my down payment? Yes, you can, and many new immigrants do this. But there are procedures and documentation requirements. When you bring money into Israel for a major purchase, the banks and tax authorities need to verify that it's legitimate funds. You need documentation of the source of the funds, bank statements from your foreign account showing the money existed there, documentation if it came from selling property abroad or inheritance, and wire transfer documentation. Important notes about bringing money from abroad. New immigrants get a 10-year exemption on taxes on money and assets brought from abroad. This is a huge benefit, but you need to document this properly. Also, when you hold foreign currency and need shekels, you're exposed to exchange rate risk. And international wire transfers take a few days, sometimes more, so plan ahead. Question 7. What happens if I want to pay off my mortgage early? Israeli mortgages have early repayment fees, and they can be substantial. This surprises many people from countries where you can pay off your mortgage anytime without penalty. Fixed-rate tracks typically have early repayment penalties to compensate the bank for the interest they lose. The penalty can be significant, sometimes several percent of the remaining balance. Variable and prime-based tracks usually have much lower or no early repayment penalties. Here's a scenario. Eli took a 2 million shekel mortgage 5 years ago, split into 3 tracks. He receives an inheritance of 1 million shekels. If he pays off the entire fixed-rate track, the bank charges him an early repayment fee of 3%, about 19,500 shekels. If he pays off the prime-based track, there's no penalty. Most financial advisors would tell Eli not to pay massive penalties for early repayment. Better to pay down the tracks with no penalties and make the maximum allowable penalty-free payments on the fixed track. Question 8. I'm over 50. Will my age affect my ability to get a mortgage? Age definitely affects mortgage terms in Israel. The issue is loan term length. Israeli banks typically want mortgages fully paid off by the time the youngest borrower reaches age 75 or 80. Mark is 52 years old and wants a 1.5 million shekel mortgage. If he applies for a standard 25-year mortgage, he'd be 77 when it's paid off. Some banks will approve this, others won't. If the bank only approves a 20-year term, his monthly payments are higher. What are his options? Apply with a younger co-borrower. Make a larger down payment to reduce the loan amount. Accept the shorter term. Or consider whether he actually wants a long-term mortgage at his age. Maybe a 15-year mortgage makes sense. The flip side, older borrowers often have substantial savings and equity from previous properties. Many people in their 50s and 60s can make larger down payments, which partially compensates for shorter loan terms. Question 9. I heard about mortgages for Olim with special terms. What are these? New immigrants are eligible for certain benefits and special mortgage programs. The main one is Mishkan, the Immigrant Mortgage Program. This is a government-backed program offering favorable terms to new immigrants. Key features: available for up to 10 years after making Aliyah, offers below-market interest rates. Maximum loan amount varies. Currently around 1.5 million shekels. Must be for your primary residence, and can be combined with regular bank financing. Rebecca and David made Aliyah 3 years ago. They're buying an apartment for 2.5 million shekels. They structure it as 1.2 million shekels through the Mishkan program at 2.5% favorable rate and 500,000 shekels through regular bank financing at 4.5%. Their blended rate is around 3.2%, significantly better than the 4.5% they'd pay for the entire amount through regular financing. Over 25 years, this saves them hundreds of thousands of shekels in interest. The bottom line, being a new immigrant comes with real financial advantages when buying property. Take full advantage of these while you're eligible, because once the window closes, you're just like any other Israeli buyer. Let me end with a complete case study that brings together many of these concepts. Michael and Jennifer are making Aliyah from the United States with their 3 children. They sold their house in New Jersey and have about 1.68 million shekels in proceeds and savings. Michael has a job offer paying 32,000 shekels per month. Jennifer is a teacher with a job lined up paying 14,000 shekels per month. Combined monthly income, 46,000 shekels. They want to buy a 4-bedroom apartment for 3.2 million shekels. Down payment needed, 960,000 shekels. Mortgage needed, 2.24 million shekels. Maximum monthly debt payment at 40% of income, 18,400 shekels. Monthly payment on 2.24 million at 4% over 25 years, about 11,800 shekels. Yes, they easily qualify. Their strategy: use the Mishkan program to borrow 1.2 million at favorable rate of 2.5%. Regular financing for 1.04 million at market rate. Split the regular portion into multiple tracks for diversification. Use a mortgage advisor to shop around and get the best possible terms. Document everything properly. Result: monthly mortgage payment of about 10,200 shekels, which is only 22% of their gross income, leaving plenty of room for other expenses. Israeli mortgages are complicated. There's no denying it. The multiple tracks, the unfamiliar terms, the bureaucracy, it can all feel overwhelming, especially if you're new to the country. But here's what I want you to remember. Thousands of people successfully navigate this process every year. You can too. The key is education, understanding how it works, and preparation, getting your documents, finances, and plans in order before you start the process. Don't be afraid to ask questions. Banks expect you to ask questions, especially if you're a new immigrant. And remember, while the mortgage process is complex, it's ultimately just financing. What really matters is finding the right property that fits your family's needs and your long-term plans. The mortgage is just the tool that makes it possible. Welcome to Israeli homeownership. It's a journey, but it's worth it.